Hello and welcome to our new Zeitgeist. This is our latest version in the new year. It's our first one since the turn of 2023. So welcome all viewers in 2023, and let's look forward to a prosperous year this year. So far, as always, the current status of play, SBF is still indicted. We're still watching that play out within the crypto markets. But quite interestingly, over the past week and a half, the market's been rallying. So we've gone from 17, 18,000 up to 21, 22, or touching 21 and looking as though it's going to go up to 22 and maybe even higher. So it's an exciting place to be. Maybe it's a bear trap, maybe it's a false breakout. Let's see what's going to happen. So right now today, it's absolute pleasure to introduce the advisor, our Fleamint advisor, Guy Shirtliff, and we're going to be discussing the topic of global asset valuations, past, present, and future, and will new age technologies continue to disrupt? So, Guy, could you please introduce yourself on what you're concentrating on in your Fleamint advisory role?
Yeah, sure thing. Thanks, James. So the name's Guy Shirtliff, South African born and raised, living in Singapore at the moment for the last 10 years. I'm founder and chief investment officer of a family office I started about 3 years ago called Stellar James Management. Prior to that, my whole career has basically been in markets and investing, mostly public equities, but more recently some private equity and other asset classes. So I've been in the market for 16 years, worked at various asset managers in South Africa, came to Singapore in 2012 and then ran a global investment fund, met with many companies over the years running more than $500 million. And as I mentioned, 3 years ago, started the family office and have been investing for myself since then. Maybe a brief background on why I kind of joined the board and was interested. I'm kind of left the asset management industry and moved to a family office, which was less constrained than your typical old asset management traditional structures. And I'm interested in change and the direction that Fleamint's going. And I have a belief that these new old technologies will be around and they will do well in the future. And I'm very keen to learn.
Oh, amazing! Absolutely amazing. So before we crack on with the questions, what is it that you love about your job so much? What makes you so passionate?
Oh, great question. It's the risk reward. It's every day the market's moving. You get a different valuation and a different opportunity set, and it's you playing against some of the smartest people in the world. And yeah, every day the matrix changes. There's new news flow. There's different rate decisions, different events, and you just get presented with opportunities every single day. There's a way to make money or to lose money. So it's not easy, but it's really exciting, and it's rewarding in the way that the market tells you when you're wrong. There's nobody else telling you you're either winning or you're losing.
No, fantastic. And you mentioned something in your answer which was quite interesting, which was about asset valuations, which kind of segues beautifully into our first question. So would you like to talk a little bit about the history of how asset valuations?
Yeah, sure. So you get the various asset classes. So as I mentioned earlier, you get private equity, public equity, bonds, and depending on the asset class, they are valued quite differently. But almost all assets you invariably discount to kind of a present valuation, and you use a discount rate, so discounted cash flow valuation, and you discount the future earnings potential or income to kind of a present. So with non-profitable tech, that's a lot more difficult because the future earnings are very far out. When you're talking about consumer staples businesses that are making 10% yields, it's a little bit easier. And maybe breaking that down into the history, I mentioned in the previous answer a little bit how through the cycles and through the years, valuations vary quite considerably. depending on what period you're in. So last year was probably one of the worst years across all asset classes. You saw one in a decade sort of events. Actually, it's happened 3 times in the last 100 years that you've had bonds and equities falling in sync. So equities were down 20%, bonds were down 15%, and private equity was hit a lot worse if you did a down round or funded. So yeah, it can vary a lot. And the year before was one of the record years. So every year the rates change that basically dictate your discount rate that you're using to discount future cash flows to get to the current levels. And the valuation changes depending on sentiment, how much money people have in their pockets, how willing they are to invest.
Okay, wow, that's super interesting. So the final part of what you said is a variable. So how is that variable normally obtained? Is it subjective? Is it like depending on the individual, the organization carrying out the valuation? Do they use that multiple or variable slightly differently to another firm, or is there like a linear change when the market changes, like the downturn now? Is there like an average that the industry kind of uses?
So it's quite, the sentiment shifts are quite linear when you get it, but individually, that's the trick to making money. If you can pick up the turns before other people and become more bearish, say going into 2022.
Yeah.
So a great example is in 2020, post-COVID, the governments around the world cut rates to zero. They printed massive amount of cash, and from that point, they created what I think is going to be called the bubble in everything last year, because everything literally went up massively in the following in 2020 and 2021. You had tech, cryptos going up 10, 20 times in a very short period. And sentiment, just, you had the retail market climbing in, became very bullish, and it's come back quite a lot at the moment. But through history, people get very hyped up. So another example is the dot-com bubble, where the internet was in its early days. The market was maybe 10 to 15 years ahead of the technology. So stocks started trading on, I always get wary when stocks and assets start trading on a multiple of sales. So you had stocks like Microsoft trading at 25 times sales, 30 times. And last year you had, or 2021, Tesla and similar businesses doing the same thing. So those are the sort of warning signs when sentiment's getting really overheated. And then when it drops to like 1 times revenue now, or 15 times PE, which is about the average price to earnings, that's when it's a little bit more bearish. And there are surveys that are done in the industry that tell you how bullish and bearish managers are. And at present, managers are kind of the most underinvested in equity markets since 2008, 2009. So extremely pessimistic at the moment, I'd say, most active managers.
Wow. Okay, and that's because most people are viewing that the market is overextended with regards to valuations. They're just way too high.
So most people become, if you follow the herd, you often get burnt. So this is the period where I like to get a little bit more bullish. It's often dictated by what's happened in the past. So as you mentioned earlier, last year was probably the worst year across all assets that you've seen in a very, very long time. And the wealth destruction was probably the most you've ever seen, going into trillions. And that hurts consumer pockets and managers' egos. They all become bearish at the wrong time and retreat.
Yeah, of course. So what's your current view of the markets? So you're saying, well, you're a contrarian, you're not following the herd, you're actually bullish right now. Are you risk on?
I was, yeah, coming into the year. At the moment, still a little bit. So yeah, as I mentioned, I'm a lot more bullish I was quite bearish towards the middle of 2021, and recently in December I turned a lot more bullish. We had our highest equity exposure in the fund. We were actually levered up to 145%, a lot of NASDAQ position, and I've kind of reduced that into the rally now. It's not always, the market doesn't go up in a straight line, and it's not easy to predict where it's going, but the central banks of the world have tightened liquidity to curb inflation, which ran away last year, and rates are at record highs. Like the US Fed fund rates still at 4.5%, will be at 5%. So that incentivizes people to save in the banks rather than invest in private equity, equities and bonds. So while everybody's on the sidelines going out the market, I think there's a lot of opportunities that have been presented. So one, for instance, is China. I mean, there were a couple of the tech stocks there trading at less than the cash on their balance sheets, which, like Buffett always says, you make money then. I'm not a massive fan of Buffett, but so yeah, to sum it all up, I am quite bullish at the moment, and there's a lot of opportunity.
And so when you're taking a position or you're taking positions, when is it that you decide that, you know, the pain threshold's enough? Do you have stop losses set at specific amounts? So you say, okay, this position, the maximum I'm willing to lose is 1% of the overall trading balance, or how do you manage risk?
So that your number one risk barrier is that subjective valuation. So everybody, the market has their valuation level, which is invariably where the stock's trading at present. And then you have kind of your bull, bear, and base case based on a worst outcome, a normalized outcome, and then a very bullish outcome. And if stocks are trading near your most bearish outcome and it's hitting like the trough where the company is probably at like a trough margin earnings level, it's trading at cash, you can't lose money over the next 12 months if you just stick with it, then yeah, I'm willing to size up and take risk and take up to 20-25% positions of the portfolio, which can bring a lot of variability and risk. But if you're managing it with that margin of safety and where you see the downside at relative to the upside, and you always look for asymmetric upside, so stocks with 100% plus upside, limited downside, and then you manage it like that. Things can go wrong and you do need to adapt, and I mean, it can become nerve-wracking when you have these big positions and then they're falling for no reason. But that's where experience comes in. When you've been doing it for 16 years, you kind of tap out, take a holiday when you need to, get back in. Yeah.
And what was one trade, or what was the one that you remember that kind of hurt the most when you took a big hit? Because most managers, money managers, traders, etc., we've all got one trade that we remember.
Yeah, there was actually a deal spread which I was playing about 2 years ago. Tiffany was being bought out by Louis Vuitton, and the deal spread was about 12%, and I really liked it. I said, these guys want this asset. It's definitely going through. It's definitely. And I took the position size up to 50%, which is probably too much for me, but I thought it's almost a cash proxy. I wasn't bullish on the markets. I'm going to park my money here. This is an easy 12%. And then they backed out of the deal and it fell 15% from there, which hit me about total balance sheet wise, about 7.5% in one day. And I did the worst thing. I panic sold at the bottom, and then the deal eventually went through. It went right back, and so that's like the most infuriating trade ever. But there is a positive from it, because it pushed me to get back into the markets and recapture those gains. And the month after that, I invested in Freeport, which is a copper company, and I had a 25% position in that, and that went up 2x, 2 times after that in the next 12 months. So sometimes these things just teach you to, it's just like a wake-up call. Yeah, humbles you. The market humbles you, they say.
Well, that's again very, very interesting, because you take a negative and you spin it into a positive light, right? And I think that being a money manager, you mainly need to be positive. You can't constantly be holding on to those poor trades that didn't go to plan, and mistakes happen. But you have to keep on looking forward and keep it positive, which is a key kind of characteristic and trait to successful money managers.
That's spot on. Like, it's the one thing I've told my two analysts that we've hired and trainee portfolio manager. It's all about confidence and yeah.
So how did you teach yourself the confidence, or did you always have it internally? You always knew that if you made a mistake, you would bring it back, or did you gain it over the years of experience?
It's the years of experience. I suppose when you start, you don't have that experience more to know that you got to stick to your guns and your experience, and then remain optimistic when everybody's pessimistic, and kind of do the opposite. But if you don't have a positive mindset and you lose that confidence, you're gone. I mean, you will second guess every decision you make after that, and you just have worse and worse outcomes. A very good book I read from Market Wizards, where they said, when you get hurt in the market, get out, reevaluate, and then get back in and clear your head. Don't stick with a losing trade or bad position. Yeah.
Yeah, no. Makes absolute sense. And for the interested viewers, I mean, you've had an amazing three or 4 years, right? Like your percentages have massively outperformed what people can generally get on the street. I mean, it's up to you. Would you like to disclose like what your past 3 or 4 years worth of P&L has been?
Yeah, sure. And I'm pretty transparent as a person generally. Nothing to hide. Like, when I left the industry, I'd taken my savings and basically doubled it a few times by taking big conviction bets in tech stocks, and then managed the family office a little bit more cautiously. So in traditional asset management terms, I've done exceptionally well, but not in like crypto or techie terms, maybe. But over the last 3 years, we up about, as we stand today, which has been a very good month, we're up about 8% this month. We up 120%. But in comparison to the market, it's really good, because equities are up 10% over that period. Bonds are down 15%. Inflation's up 10%. So and most managers have underperformed during this period, because it's been a massive rally up and then a big crash. So we've had to adapt through almost 3 cycles in the last 3 years, which has been very fortunate. And no, I'm very pleased at the way I've done. So started the family office with about 25 million Sing in total assets, and now we're just going above 50. And we just started hiring some analysts and building a team and rebranding, and we're going to attach a Singapore investment fund and open the fund up to new investors potentially, depending on to share the returns.
Wow, absolutely amazing. Well, yeah, we'll be certainly trying to funnel people your way, right? So, all right. So going back to what we were discussing before with regards to asset valuations, and then you were mentioning 2021, you were bearish, and now you've moved into more of a bullish stance into 2022 and 2023. So how does the current market differ to how it's been across the last like 5-10 years? Where are we right now?
It's actually really tricky, because it's the first time you can actually get a yield on your cash. If you put your cash in the bank, US dollars, you can get 4.5% just by leaving it there. Previously, you're getting 0. So people were forced to go down the risk curve. Your first step is cash, then bonds, fixed income, then equities, then private equities, and crypto. So it really pushed everybody down the risk curve. And so those are the classes which have been hurt the most since they've hiked rates to a level that's probably well above where inflation is going to be, and they'll have to bring it down. As they bring the rates down, probably not to this last 5 year sort of level, which is zero. If they bring interest rates back to 2.5%, you'll get a re-rating in a lot of these risk assets in tech. And if you look at the way they went, I always look at Cathy Wood's ARK fund. I mean, it's got the same pattern as every bubble. So the first 2 years it doubles, 3 years it doubles again, and then that last year it goes up 5 times from there. So it goes up 10 to 20 times, and then it collapses 75%. So if you look at the .com bubble, the tulip mania, the South Sea bubble, all of it's the same. And her funds collapsed 75%. So Tesla, Bitcoin, big holdings, Zoom, sort of those techie, future, innovative stocks. And so that's just saying that we through the worst, I believe. Like, you can buy these things now in a view that rates come back down.
Oh wow! So you're technically right now you're super bullish.
And not like 100%, because things can change. There's always geopolitics, elections next year in the US. The place which hasn't recovered, I'm super bullish China, I'd say.
Okay.
Yeah.
And which for the viewers watching this, where are you less bullish than China?
Europe's going to struggle with the energy issues they're experiencing. Their high energy costs will continue to drag big manufacturing countries. Their social systems are a little bit tough to uphold. They can't push rates too far. Yeah, the demographics are not in their favor. A lot more aging, less innovative, less growth. The US has always been super productive over the years and reinvents itself and changes. They're in a tricky spot, but they always seem to get out of it. But Asia is the future.
Okay, and why is Asia the future? Is it due to technology, or what's the reasons?
A lot of it's demographics and wealth creation. So a lot of the wealth creation, the middle income class will be coming through. They'll be investing. You'll find new businesses developing here. The talent pools will start growing out of here. Innovation. I mean, we based in Singapore, and the stuff that they're doing with these venture hubs and incentivizing this sort of stuff is, it's quite progressive.
And what about your home country, South Africa? What's the outlook over there?
Yeah, they're struggling with power issues, so they don't have enough power to kind of produce anything more than they have at the present. So they need to resolve that, which will probably take 5 to 10 years to restructure the whole power system there. And without the power, and there's a drain on talent from South Africa, so you need education and almost go through a generation where you've got the youth coming through and driving the economy and productivity, changing the government systems. A lot needs to happen.
Okay, so challenging.
Yeah.
Understood. All right, and then looking to the future now. A slightly different subject. Do you think that new world technologies will continue to disrupt as what we've seen like in Asia?
Yeah, 100%. So this is the question now where everybody last year, cryptos and non-profitable tech was like the poster child of the crash, and they're like, all of this stuff was fake and it's crashed and there were fakies in the market and da. But it's not really true. If you look behind the new world technologies, just like the .com bubble, Microsoft, all of them were well ahead of the internet and the gains. They all went up 20 times and then came back down 75%. And there was a lot of junk that went up and got flushed out. And I think we've seen a similar thing happen now. And I believe what you need for the future change is regulation to catch up. First of all, you need mass adoption, which we're starting to see, which forces the regulation, by the way. And as you get into this change, it'll be it'll be a few years down the line. I still think, I mean, we had that discussion on the metaverse and where we are. It's probably still 5 to 10 years out before you see the real monetization and the benefits. But it's coming. These new world technologies, like JP Morgan yesterday applied for a crypto branding for their crypto wallet or something. Last year, Jamie Dimon, the CEO, was saying, "Oh, we hate cryptos and it's fakey." And so it's interesting to see what the big banks are doing. They're all setting up behind the scenes and taking on blockchain technology, NFTs, all of this. And it's really disruptive stuff. I mean, if you just trade equities, for instance, settlement used to be T plus 5, which is today plus 5 days, come all the way down to T plus 1. But it's still inefficient and costly. You've got the banks in the middle. You need a counterparty and settlement, and there's fees charged, and there's a time lag and mismatches. Where you look at some of these smart contracts, it can be instant with like almost no cost. It's exactly what Fleamint's doing. So yeah, I think there's definitely use for these technologies. Cryptos as an asset class, I'm pretty sure see digital currencies in the future. I mean, China's been quite active in that. They've already got a digital renminbi that you can use on the phone, etc. And I think the world will move to that, and cash will disappear, and these wallets will be around. And the question is, like, maybe to you, is how much do consumers want the governments knowing all of their data going through these sort of channels? Because without cash, will be a strong record book of every digital token you've spent or coin.
Yeah, so this is actually what I class as the fallacy of crypto, right? So far, people say, "Oh, decentralization," and the governments are not going to understand what you've been spending or where you've been sending your cash. But as soon as the government understands whose wallet is linked to which person, which is essentially the travel rule and the VASP transfers and this kind of stuff. So they're slowly implementing rules and regulations around wallet holders. But then right now, because of decentralization process, so right now I could download like a Trust wallet, or I could download MetaMask. And I think MetaMask has a functionality now where they are working with governments, but there are many other wallets on, say, Solana or on different chains that are not traceable. And that decentralization means that, you know, no government in the world knows who essentially owns those assets, and it's up to the individual after reporting to the government saying, "Hey, oh, by the way, I've got X amount of cash in my crypto wallet." So it's an interesting place. And then yesterday I've been thinking about regulations a little bit around cryptocurrency, and I'm wondering why it's taking certainly the US so long to roll out regulations, because normally like the SEC or the CFTC or one of the bigger regulators, right, would normally come out by now. And crypto's not new. It's been out for some time, and there's billions and billions of dollars that's transacted in it. So I would have thought there would have been some kind of like blanket coverage by the US. But then yesterday I was reading the SBF debacle, and they were constantly gifting to the Senate and the senators. So I think that, you know, the powers that be that are actually controlling this are being monetized in some way. They're being supported by cryptocurrency participants in order for there not to be regulation, so that people take advantage of this kind of stuff. So you're very much in a regulated market, right? Do you think that crypto regulation is close, like from your personal experience of global regulations and working with regulators? Do you think there's cryptocurrency that's in the pipeline? How close do you think it is, or do you think that we're still at least 3 or 4 years of the way, which is where I still think we are still some time away?
Well, you're probably right. You know a lot more than I do, but I would say it's definitely coming, and it's being pushed. If you look at the more proactive governments in the world, like Singapore, I mean, they've been giving licenses to a lot of exchanges, and they're the most proactive and forward, and they can see it's coming. So, I mean, I think we're in the right place, if I can put it that way. You'll know exactly when it's coming in the US and the rest, but they've been talking about it for a while, and as soon as they regulate, they almost legalize it in a way. So yeah, so it's yeah.
Yeah, yeah, you're right. It's almost like they give it the stamp of approval, right?
Yeah.
Which is what I also don't think that they really want to do right now as well. So they're kind of in a rock and a hard place, right? Because they're like, if we give it the stamp of approval, then the masses there's mass adoption. So they're kind of like, yeah, we want to regulate it, but we kind of don't know how, and it's almost in a place of flux, which is quite interesting. It's super disruptive.
You know what I think they're waiting for their own launch of their own digital currencies before they regulate, because they want to steer people into those which they can track and then monitor for tax and etc. Very interesting. That's why I love listening to you and your team.
So that actually brings me on to my next question is, do you think that physical cash will eventually disappear? Because there's lots of CBDC, central bank digital currencies, especially the Chinese digital yuan. I think the Bank of England as well is looking at the sterling, pulling the pound, even though it's lost a lot of value recently. It seems as though that's also going to be a central bank digital currency, and there's many other central banks globally around the world that are going to be creating digital currency. So do you think that physical cash will likely disappear?
Yeah, that's probably the easiest bet on like a 10 to 20-year view.
Okay.
Because as you explained earlier, it's worse than going to a system where there's digital currencies. It's where most of the shady stuff happens. It's all in the cash market. So yeah, it also reduces a lot of friction in economies. To distribute cash is really costly, and to hold cash at the banks, and that's a friction that saves a lot of money for the whole world and pushes global growth forward. So we've already moved towards. The cash rate usage must have dropped massively with introduction of all these iPhone wallets and Android, and I hardly draw cash anymore. So especially in emerging markets, they can leapfrog like a whole system. I think in Kenya they got M-Pesa, which is phone-based payments and system, and it's almost 100% adoption rate. Yeah.
Does this, for me personally, I think because there's a lot of governments out there that are corrupt, right? And governments inherently take from their own people, right? And not mentioning any countries, but there are many countries like that.
Yeah.
So do you think that they'd be dissuaded from adopting a digital currency because everything then becomes transparent and on the blockchain? So then, many people that would ordinarily make a lot of money from shady dealings are then no longer be able to do the shady dealings unless they kind of mask it on the blockchain somehow, which is pretty hard to do.
Yeah. Yeah, 100%. I think you're right. So they will be pushing against it. The factor that breaks it is mass adoption. So it's similar to, I've highlighted Airbnb and Uber before. They actually broke in New York. It's like almost $1 million to get a taxi license. These guys were just signing up for Uber and driving around with an app for free and charging massive fees. And the taxi regulation had to catch up. They try to block it. Like shootouts happening, like weird stuff. And once it becomes mass adopted and you just can't stand in the way of the crowd, it forces change. So yeah, those governments will have to change.
Which is absolutely amazing then, because essentially it will make the world hopefully more efficient, where the people that need support actually get it, because corruption hurts the poorest sector of our society, or in any society, right? So, all right. So, how do you feel that Fleamint will disrupt global industries? Because obviously, you joined you joined the Fleamint advisory board, and I think you like what our vision and what our aims are. So, yeah, how do you think that Fleamint will disrupt global industries, and how will that affect the markets?
Yeah. I mean, linking real world assets to potential buyers through these sort of smart contracts or tokens that you provide is a very valuable solution. And I mean, like, let me talk about the asset management industry. I think it's just like banks selling equity products or bond or portfolios at 1-2% charges, massive fees and rates is just very old world. And you've seen the new retail market. They all want to trade online for themselves. They're a lot more tech savvy. They're not going to go speak to some guy and he's going to go, oh, buy this fund from me, you'll make 5% a year. They'll be like, I'll just go buy this coin or whatever, or asset, like technology wise, off my phone immediately. And I mean, that's where you guys stand. And you can, I mean, it's going to be a big task to work through the regulation and get through it all, and then get the tech up to the level where it's 100% perfect to make sure everything's tracked and governments are happy. But it's coming, as I said, like that's the direction of travel. And if you could distribute funds or equities through your sort of contract token with the ledger behind that, who owns it, what's happened, and it's instant with low friction cost, immediate. I mean, geez, that's a massively valuable solution.
Yeah. I totally agree. I mean, for us, tokenizing real world assets, goods, services, because there's been a lot of like meme coins, right? So you see many meme coins that are not backed by anything. It's just market momentum and hype, and whoever has the best marketing approach or budget and spends the most in their marketing gets the retail, the retail crypto players to go in and pump tokens up with zero validity, right? Which I guess also segues quite nicely into how you assess businesses, right? Which is discounted cash flow valuations. You actually delve in, and I'm pretty sure if you was to delve into 80 to 90% of these tokens, you would be looking at them thinking that the value should be close to zero. So have you ever, so question, have you ever traded Bitcoin? Have you ever traded Ethereum? Is it something that you're looking at doing? Is it something you're interested in?
No, never before. So I'm probably one of the biggest crypto skeptics in terms of the tokens that are traded out there. But I have helped with working capital financing for a crypto exchange where they were doing or arbing, and they've returned 27% over the last year, so it did well. I was quite pleased in a market that's down 20. So I definitely see the value in the exchanges, your sort of business technology-wise, and where you're going with the real-world asset link, not just creating a dog coin or something and then getting excited about it. As I said, there's definitely value in the technology going forward. And if you're the early leaders and you're doing it right, and it's going to be massive, the market.
So after building your own business from 25 million now up to 50 and going super strong from there, doing a brilliant job, what advice would you have for anyone else looking to do the same thing? Like what be character traits that they would need to obtain or have? And yeah, how would you assist them, or if you just give a quick summary?
It's having a clear direction and plan. And you've mentioned a few of them, being an optimist and having the confidence to execute. You're always going to have the small bumps and hiccups and issues along the way. But if you have a clear vision where you're going, you'll get there eventually. And don't sweat the small stuff. Just keep moving forward, believe in yourself, and remain an optimist.
Yeah, fantastic. Cool. So it's been an absolute pleasure to have you on today, Guy. Every single time we meet, we chat, I'm enlightened a little bit more. So really appreciate your time, and I really wish you the best of luck this year. especially with your new team members. I'm sure that they will perform fantastically well under your guidance. And yeah, thank you so much for joining us today.
And thank you likewise. Like every time I chat to you regarding this stuff, it's like hieroglyphics for me, and you teach me a lot and give me confidence in the industry and certain parts of the technology, and it's great learning from you. And thank you for having me on the advisory board and on your chat.
Really appreciate it. Thank you so much. And thank you to all of the viewers that have watched this. Before we conclude, I would just like to quickly summarize a little bit about Fleamint. We are a consultancy where we assist and help Web 2 business move into Web 3. We are tokenizing real world businesses with real assets, allowing them to extrapolate value from Web 3. We allow Web 3 participants to be able to partake and access real world assets, goods and services that they would not able to normally get. So we are almost like the bridge, the conduit between Web 2 and Web 3. We've built and building an NFT marketplace. We have a partnered decentralized exchange. And we are also going from strength to strength. So please do not forget to like, subscribe, and comment in the YouTube channel. If you're watching this on YouTube, or if you're on any other medium, please like and subscribe. Thank you so much. And thank you again, Guy. Take care.
Cheers.